Hello, I'm Jared Nelson from the Investing Channel, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind trending ideas in the market. In today's bullish market, it is increasingly difficult to find value bets. Excessive monetary inflation has pushed asset prices up across the board over the past 12 months. The U.S. stock market, for example, has been appreciating continuously since March 2020. Seasoned investors look at the valuation data, and most of them conclude that U.S. equities are expensive. However, one successful fund manager, Research Affiliates, managed to find a macro idea with such a high conviction that it called this opportunity the trade of the decade. What is the great idea? Buy UK equities. The first question that springs to mind is this: why would anyone invest in the UK right now? The country has just completed a drawn-out, messy, 4-year battle to leave the European Union. Its future outside the richest trade bloc in the world is not yet secured. Fear not, says Rob Arnott, one of the authors of the article. UK stock prices are so cheap these days that most pessimism is already reflected in current prices. At the end of 2020, he observed, UK stocks are trading in the cheapest quintile of their historical norms, based on both price-to-book and price-to-5-year average cash flow ratios, and in the bottom third based on price-to-5-year average sales ratio. Therefore, in light of this data, UK stocks are trading at a bargain level. This is in great contrast to the exuberant US stock market. A quick look at the long-term iShares MSCI UK ETF chart with ticker EWU generally affirms this assertion. At $32, the ETF is trading at a price level dating back to April 1997, a full 24 years ago. No doubt, UK stocks are in a severe relative bear market over the past few years. They have underperformed many other asset classes. What, then, will cause the market to re-rate UK stocks upwards? There are a few positive factors in store for investors willing to take the risk. The first is the rapid vaccination of the population. At the current rate, the UK will be one of the first countries to vaccinate a large proportion of its adult population. Once this is done, the country can open up its economy quickly and resume daily activities unrestricted by social distancing measures. In contrast, the EU is in danger of a double-dip recession, while South Asia, such as India, is mired in the dreaded second wave. This relative speed in opening up the economy may drive capital back into the UK. Another important factor is this: Brexit is finally over. Uncertainties related to that event are behind us, and this means the UK is free to strike trade deals with other countries. This will provide some certainties and impetus for the economy going forward. Look at how fast pound sterling has appreciated earlier this year once Brexit was done with. The third reason for buying UK stocks is that value stocks will, at some point, narrow its performance gap relative to growth stocks. The desertion of value stocks in the latter years of the last decade caused investors to avoid the UK market because many British stocks were in low-growth cyclical sectors. But growth stocks will not outperform value forever. At some point, growth stocks will be significantly overvalued, and investors will probably switch back to cheaper value stocks. UK stocks will benefit from this reversion. A related point concerns dividend yield. A fair number of UK stocks are good yielders. For example, Rio Tinto, the £100 billion miner, has a dividend yield in excess of 4.5%. A few large-cap insurance stocks yield more than 3%. The two tobacco stocks, British American and Imperial, fetch 7% each, and BP and Shell Dutch both yield more than 5%. Therefore, even if prices stagnate for some time, investors would derive reasonable income from these stocks. But being cheap does not mean UK stocks will immediately rebound. Too many uncertainties are still dragging investor sentiment here. For one, is the UK really better outside the EU bloc, economically and financially? Increased trade frictions are generally not good for an economy because it increases the cost of doing business with trade partners. Second, what is the growth story in the UK? We have a few tech-related IPOs recently, such as Deliveroo and Darktrace, but these are not Google or Amazon. The tech ecosystem in the country is generally not as vibrant as those in the US or China. Lastly, what is cheap can stay cheap for years. At the moment, investors are sticking with US tech, crypto, or cyclical sectors enjoying a post-pandemic boom. UK stocks are overlooked and under the radar of most international investors. there is no obvious catalyst to re-rate UK stocks. As a contrarian bet, British stocks are one of the prime candidates. Valuations are inexpensive, sentiment subdued, and expectations low. But is it about to change? Hard to say at this point, because investors are still unsure if the country can adjust successfully after Brexit. Yes, it can be a wild card, but we would not put a substantial part of the portfolio into the idea, and be prepared to hold the position for some time waiting for the prices to revert to its historical mean. That's all we have time for this week. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.